Let's bring in Jim Paulsen now, who helps oversee about $320 billion in assets. He's the chief investment strategist at Wells Capital Management, and Businessweek has named him a top economic forecaster. He joins us from Minneapolis. Good to have you with us, Jim. Now, I was going to play you some sound bites of what Paul Krugman has to say. He basically says the U.S. has to use the kitchen sink strategy right now to bail the economy out of recession. Do you agree with those thoughts and that sentiment?
I don't really, Susan. I think that I think the U.S. indeed the world economy is experiencing a very common mid-cycle recovery soft patch. It happens a lot. It happened in 2005. It happened back in 1985. It happened back in 1995. So we tend to have a blow off the bottom and then a period where the economy slows. The reasons that we're doing that, I think, are that leading up to this in March, Treasury yields in this country, 10-year, was pushing through 4%, had risen from 3.2 to 4% in the first part of the year. Oil prices were pushing through $90. The U.S. dollar had appreciated a lot. The Chinese officials were tightening to slow their economy, and a lot of those were tightening forces that slowed the economy. But now, if you look at what's happened, without doing any more stimulus, the 10-year Treasury in the United States has fallen back to 3. Oil prices have come down to $70 again. Now the U.S. dollar is starting to weaken. Chinese officials are done tightening, if you will. I think that alone is going to be enough stimulus to help the economy regain strength in the last half of this year.
Really, Jim? Because people have been looking at some of the economic numbers we've been getting out of the U.S. Manufacturing disappointing, jobs numbers still a bit weak, and then housing prices and housing itself is still not coming back to certain stability levels. There are still a lot of concerns about whether or not there's going to be a double-dip recession in the U.S.
I think, Susan, that, again, I come back to, I do see those weaker reports, and I think they're the result of earlier year tightening in interest rates, oil prices, the dollar, that is still, as a lagged effect, slowing the economy somewhat. I totally agree with that. But what I think is the bigger thing is I think there's a great reaction to this, taking this softer patch in a normal sort of cycle recovery and extrapolating it to a double-dip recession. I think that is overdoing what is really happening. I think we're suffering a little bit in the post-2008 crisis from Armageddon hypochondria. We get any evidence of any slower economy and we instantly take it to death. And I just think that that's not what's happening. I think it's a normal pause in a recovery that's ongoing as opposed to increasing a big double dip risk.
Okay, Jim, if you see recovery in the U.S. economy, then should you get in front of the curve? Should investors be getting in front of the curve and maybe picking off the bottom in terms of what we're seeing for stocks? Because they have been pretty much going nowhere for a while, if not just downwards.
Yeah, I mean, we've basically been flat now all the way to last fall throughout most equity markets, not only in the United States but around the globe. I think it's a great time to pick away at that. We have been growing in this economy. We probably grew about 3 to 3.5% of the second quarter real GDP in the United States. Profits are still growing. I think they're going to have another great profit quarter reporting starting next week. And now you've got a 15% reduction in the values that you can pick at, while long-term interest rates have come down 1%. I think it's a great time to be picking away. Give yourself a year or two to get some results. We may go lower over the next few weeks. I don't know. But over the next couple of years, I think you're going to be very happy if you buy some stocks in here in the next few weeks.
And Jim, quickly, tell me why playing defensive right now looks like a lose-lose scenario.
Yeah, well, historically, there's a lot of people that say, okay, well, if you're going to enter in defensive sectors. But I think defensive sectors typically, relative to the market, do best when bond yields go down, Susan. And from here, if bond yields go down, the only way they're going to go down lower in the United States is if there's depression fears, if you will, which means you may outperform the market, but you're still going to go down. Alternatively, if the economy does come back better than people think, then bond yields are going to go up, and the best place to be is not going to be defensive stocks. So I just don't like the defensive stock risk-reward ratio right now. I'd either, if you're going to be in the market, I'd come in with cyclical exposure to the economy. If you don't want to be in the market, then I'd just buy the bonds rather than buying defensive stocks.
Okay, Jim, thank you so much for your time. Nice talking to you, as always. Jim Paulsen of Wells Capital. Now